I tend to cover a lot of material, though tonight I did purposely throttle myself back quite a bit, but I will occasionally go off on a tangent or two, and if I begin to talk fast or something like that, don't worry. This is not a one and done thing. I have over 500 articles on my website and quite a few videos, and I have 1,500 YouTubes out there. So there's lots and lots of follow-up information. Then I'll give you some more information towards the end about what's at this davelandry.com/fest link, and that's some special offers and some follow-up information. And also, I do answer my own emails, so you can reach me at davelandry.com/contact. If it's an answer requiring a lot of thought, I do a weekly webinar, usually once a week. Lately, there's been some scheduling issues, but usually once a week. And I have another one that's going to be on Thursday, and I'll cover it in that. So you're not going to be left alone in any of this stuff. Now, what are we going to talk about? Well, tonight I want to talk about an incredibly simple way to stay on the right side of the market. But before we do that, there's a disclaimer screen. Now, obviously, you can't read it that fast. Nobody's ever read one anyway. There are some interesting things in there, though, such as if you smoke after sex, you're doing it too fast, and a lot of other funny and interesting things. So if you get bored, you can go to my website and read it. I'll just surmise or boil it down to what a friend of mine, Greg Morris, used to say, or did say once, and I lifted his line. And happy birthday, Greg, by the way. All predictions are about the future, and a lot of stuff can happen between now and then. That pretty much sums it up. But do take a look at those disclaimers on my website. Now, we all tend to go on a grail hunt, and I'm going to talk about that really briefly before we hop into the crux of the presentation. But after searching for many, many years, I began to peel away all these indicators and just look at the blank charts mostly, and then slowly put a few things back on here and there. And then I began to ask myself, how do I make trading simplified? And I decided to go ahead and trademark that phrase. And it's something that I very much believe in. And when we start trading, we all begin with basics, but then we go, or we all tend to go, most of us at least, on a grail hunt where we begin to increase the complexity. And what happens is the confusion usually begins to set in. And at some point, we might end up studying the complex and arcane. Now, I would never throw anybody under the bus, so I'm not going to point out what methods I think are complete BS here, but maybe there's a 2-drink minimum on that, and we can discuss that privately. But for me, the true enlightenment, and I think for many, comes when you begin to decrease the complexity of what you're doing. Now, this is a quick little summary of the first few videos in this Trading Full Circle course, which I'm going to give you at the end of this presentation. So I would encourage you to go out and watch them. If you're new to trading, some of it might not make sense, but I can guarantee you, if you're somewhere over here in the curve or struggling at all, it will make a lot of sense. But I just want to let you know that this, what I'm going to show you tonight, has come from many, many years of going through these grail hunts and then just peeling away those indicators and going back to something very simple. Now, speaking of price indicators, most of the time I use a blank chart. I do occasionally use a moving average, and I think in one of my prior Festival Traders presentations, I talked about the bow tie pattern, which has become very, very popular. We will be using a moving average tonight as an indicator, but before we do that, just remember that all price indicators are derived from price, and as a derivative, all will have lag. A lot of people say, well, my indicator does this and does that. No, it doesn't. It indicates, it illustrates what's already in the chart. Sometimes you look at a blank chart, you might see one thing or another, but when you put in some sort of indicator, and usually, again, I just keep it simple, maybe it's just moving average, it might show you something that you might not have seen, but it's not indicating anything. It's simply illustrating what's already happened in price. Now, in case you're wondering where this concept of daylight comes from, and that's what we talk about tonight, in 1995, I'm dating myself a little bit, but in 1995, I wrote an article for Stocks and Commodities magazine, and it was a simple little breakout system to be used in the dollar versus the Japanese yen. And all it did was look for a little breakout from the 20-day exponential moving average. And if you Google the 220 EMA breakout system, you should be able to find it for free on the internet. There's so many copies out there now. You should be able to find it for free. It's technically I can't give it to you because it's they charge I think 99 cents or something for it because Stocks and Commodities owns the article. The point is that daylight, the term came because the price is breaking away from the moving average. And a gentleman that read the article emailed me and said, I like that concept of the price breaking away from the moving average. I call it daylight because you can see lights in between the moving average and price. Now let's take a look at what that looks like. In more recent times, a client of mine suggested I call it Dave Light because I was complaining because I never got around to naming something like my friend John Bollinger putting his name on his indicator. So from now on, we're going to call it Dave Light. Now, it's so simple, it's amazing. It's just the lows of the price bar are greater than the moving average for uptrends, and the highs of the price bar are less than the moving average for downtrends. Now, you're going to be amazed at how something so darn simple can be so useful in the markets. But before we take a look at that, let's just look at what that would look like. Notice that the lows here are greater than the moving average. Now, you could use whatever moving average you want. For certain patterns, such as my bow tie patterns, I use a combination of exponential, moving average, and simple. For tonight's presentation on, I think, all of the charts, we're just going to use a 50-day simple moving average. But I've actually used this pattern with a 5-day moving average as a little breakout system for IPOs. Now, I don't want to digress too far. I'm not a breakout guy. I'm more of a pullback type of player. But I have learned over the years that breakouts can work really nicely in IPOs, especially when you're using the concept of Dave Light. Now, this is what it looks like on an actual chart. Notice that there's the light between the lows of the price and the actual moving average down here. And if you connect a line, you could see that the entire line does not intersect the moving average or the price. So there is, again, that Dave Light in between the moving average and price. And notice over here, when the market began to roll over, you begin to have the downside daylight. Now, here's the thing, and this is why I like this concept so much. Although an indicator is actually used, the lag is reduced by requiring specific price action. So in the prior chart, I showed the moving average slope. Well, moving average might still go up for quite a while, even though price begins going down, okay? Now, I talk a lot about this and the beauty of the exponential moving averages in Trading Full Circle in those free videos that I'll give you in the end of the presentation. So check that out if you get a chance. But the point I'm trying to make is some of the lag is removed by requiring a price-based action with an indicator. Now, recently I began working with Metastock, and they actually are going to publish the daylight indicator along with some pattern recognition for quite a few of the rest of my patterns, at least the favorite patterns of mine. And that's going to be out in about 2 months or so. It's in beta testing right now. And it's been really cool. And one of the cool things that came out of it was this days of daylight indicator I asked in the program for me. Now, let me explain to you what it is, and then I'll show you how cool it is to actually use it in real charts. It's just counting the number of days that the lows are above the moving average for uptrends. And you can see that's here, okay? And then for downtrends, it's counting the number of days that is below the moving average. Now, keep in mind, it does not measure magnitude. That's a completely different type of analysis. It's something I'm not really into, but some people do it. And it does make some sense that when a market gets so far away from a moving average, it's prone to revert back to the mean. But that's not what we're trying to accomplish here. We're simply trying to see, or actually measuring through a hard mathematical calculation, how many days the market is above or below the moving average. Now, it's not cumulative. Notice that after these big spikes that it comes right back down to zero. And if the market goes right back above the moving average, the lows get above the moving average, it'll start climbing higher again. If you are interested in getting these for free, you can go to my website, davelandry.com/getting started, and you'll notice about halfway down I talk about charting. I use Telechart quite often, and I also use Metastock if you're interested in getting your charts set up. Now, on the top we have a positive count, and on the bottom we have a negative count, and I'll show you what that actually means once we look at a real chart. The cool thing is there will be daylight during major bull markets and bear markets. That's one of the few things that I can guarantee in this business. There has to be. Therefore, all bull and bear markets will begin with daylight. And this is why I think now is the time that we need to pay attention to what's happening in current markets. So if we go back to our chart and we go back to the mid-90s, right around the time when I was first getting published and discovering this daylight concept, you'll notice that during this great bull market of the 90s, we had positive daylight throughout nearly the entire time. We had a tiny, tiny bit of negative daylight, and you really have to squint your eyes to see it in that entire leg higher. And that was a great bull market, which ended in 2000. Now, notice what happened after 2000. We had negative daylight for almost the entire time. We had zero upside daylight, which is fascinating to me. And that was for a long, long time until that bear market ended, obviously, in 2003. And then look what happened. We had positive daylight and absolutely no negative daylight for years while we were in that great bull market. Well, we all know what happened next. We had, obviously, the market began to roll over in 2007. I had other signals such as the bow tie moving averages turning down on both the daily and weekly chart. And by the way, I knew I would forget, this is a weekly, or I'm sorry, this is a 50 period moving average, okay? And this is the weekly chart. So this would be a 50-week moving average, but the same concept applies to, as I'll show you in 1 second, daily charts and intraday charts because patterns are fractal. Now, continuing along, notice that, again, during this great bull market that we had from 2003 to 2007, there was absolutely no downside daylight, although the market did come down and kiss the moving average a few times. And then, of course, in 2007, the market sold off fairly hard, losing about half its value, which is pretty significant. And notice that there was absolutely no upside daylight on the 50-day, or in this case, 50-week, because it's a 50-period moving average in the S&P 500. And then we began to have upside daylight. You had a tiny bit of downside daylight, but you have to really squint your eyes to see it. Now, in 2011, I got a little bearish, and if you look at the chart, we did have some weekly downside. I did short quite a bit in here, okay? And then the market did come back nicely, and now, in perfect hindsight, of course, we know that that was just a correction, but we could also look at the number of days of daylight to see that it really wasn't the beginning of something huge because the market quickly turned green once again. Now, continuing on, obviously we've had a couple of more corrections, and if you go back and look at the archives of my recommendations, you'll see that I did get somewhat bearish back then, and I did put on a few shorts. And towards the end of this presentation, I'll show you where we are now currently. Now, even after that little bit of what turned out to be a correction, and you can see we didn't have a whole lot of downside daylight, we've been in this nice run for quite a while, ever since 2016. Now, if we go back and look at this longer term, much, much longer term, we can go back to the 70s, and you could see that. Now, I'm not a reversion to the mean player, and I don't believe in selling a market because it is high. But one thing that's kind of interesting is at these peaks, and roughly about 100, and I have 50 drawn in here, should be 100 down here, so a little bit further down. But you can see that when you begin to have these big spikes up, you tend to see some corrective action afterwards. So again, I would not sell out, and I'll talk a little bit about money management in a second, especially if we have a little more time, if we have enough time, I should say. But I wouldn't necessarily dump a market, but if you are following your methodology, which requires you to scale out of positions, then by all means, scale out of positions and honor your stops when you see the market at these extremes. So as I just implied and showed you, the market does tend to correct after extreme readings. And the extreme readings are 100. So if we look at the crash of 1987, you can see that the green got pretty high in here. Now, one thing that I don't think it would test out or work, but somebody pointed out, what if you took a cumulative count where you would just add it all up? And I think that would further complicate things. Again, I like to keep it simple. So all this does is count the number of days above. But you can see, even if you go further back, you can see that all of this was also green. So maybe that's fodder for additional research. And if you guys begin to play around with that, let me know if you think you find something. But notice that we did get into this really extreme readings up in here, and this was before the crash of 1987. Now, here's some more observations. Now, this is something I've already known because I remember the American Association of Professional Technical Analysts, and that was split off from the, I think it was from the CMT many, many years ago. And through that membership, I've learned that markets spend more time going up than going down. But that's a rather poor argument for buy and hold, because it's the magnitude that kills you. And let's say that you've been saving for retirement for a long, long time, and then a year like 2000 comes along, and then obviously the market goes down 50%. Well, if you save $20 million, then you're probably okay. You still have $10 million left. But, and this is one of Greg Morris's arguments too, if you saved $1 million, well, now if you only have $500,000, your lifestyle is going to change a little bit in retirement. So if we take a look at the Dow Jones, because that's the best data going back for a century or so, you can see that the market does spend a lot more time in a bull phase, or at least with positive daylight, than it does in a bear phase. So the market, yes, does go up more than it goes down. Now, by the way, and this is something that I pointed out again in those first few videos of the Trading Full Circle, is that those longer term predictions that the market always goes up is based on an 80-year time horizon. And as Sweet Brown once said, ain't nobody got time for that. So I wouldn't use the fact that the market goes up more than it goes down as a argument to just buy and hold. I mean, obviously you get a year like 1929, 1930, and things look pretty ugly. And you don't have to go all the way back to then. Obviously in 2007, market lost half its value. And then in 2000, the NASDAQ lost over 70% of its value. So be careful with those Wall Street adages, such as the market always goes up longer term. Now, I just showed you how cool I think this is, but keep in mind that as great as it is, like anything, it isn't magical. And as I said a minute ago, as trend followers, there's no need to exit at extremes, but do be prudent with your money management. And now might be one of those times. Now, if we go back to the crash briefly here, you could see that this market sold off really hard. And there's a better than average chance. I hadn't started trading in 1987. I started in the early 90s. But I can pretty much guarantee you, based on my methodology, I would have gotten stopped out of all my positions based on the magnitude of that slide before the crash actually happened. So what I would recommend you do, and again, we're not going to get into the money management heavily tonight, but I do have some special reports that I can give you on that will get you up to speed, is let the ebb and flow control your portfolio. So you want to exercise proper money management and listen to the database. So that means that I do use stops and I do honor those stops. Now, I'm not very proud of this portfolio, but this is the open portfolio, and this is where we are now. I just want to show you that we have one little long left over, one lonely long, and now we have two shorts on. So we're listening to the database, and we're letting stops take us out of positions. And if we're seeing more shorts than longs, we're beginning to short a little bit. And if the market continues to go higher, as it has been lately, then we'll go back to becoming more long. Now, a couple things. One thing that I've been noodling with is, does this help to confirm, does Dave Light help to confirm that tops are more of a process than an event and bottoms are more an event than a process? Now, this is just the opposite, and this is something, again, I learned from the AAPTA. Tops tend to be more gradual, believe it or not. Everybody gets excited about the crash, but usually the market will top long before that crash happens. And bottoms, you think a market just kind of scrapes bottom forever, but in reality, you do have more V-shaped bottoms, such as, for instance, 2009, when the market came flying off its lows. So if you look to this indicator going back and looking at the Dow, it does help to confirm that it takes a while for the market to top out, and then the recoveries are pretty sharp and happen fairly quickly. Now, by the way, I'm going to give you all these slides, and I'll show you how to get them at the end of the presentation. So if you want to go through them again, you'll be able to get all these charts, and I think it'll make more sense. But even in the crash of '87, you can see that this market sort of gradually rolled over. And again, we did have that one big down day, which ended the streak of this upside daylight, okay? So even that crash, which we see as a crash, and it's got the name crash in it, in the title, obviously, the market still did sort of top over many, many months. Took it about a year or so to top. So I think that's some interesting fodder for research. I just want to throw that out if you guys want to take the ball and run with that. Now, like all patterns, it's fractal, okay? And I'm always asked that, could you use this on an intraday chart? Absolutely. You could use it on a monthly chart if you want. So if we look at an hourly S&P, notice that when the market began to tank, you had daylight to the downside, okay? And that happened long before the market actually had this big, huge correction that we recently saw. And you can see we've had some upside daylight and a retrace rally and a little downside daylight as of late. Now, very briefly, where are we now? That's what everybody's wanting to know. Well, I like to look at a weekly chart to gain perspective. Now, again, as I said a minute ago, chances are when the market does begin to correct, as it has lately, I will begin to get stopped out of my long positions, and I will begin to put on some shorts. I use mostly a daily chart, except for in Forex, I will use hourly charts, and I don't want to digress too far into that. But if you check my website column now, NOW, with Dave Landry, there's a little bit more on how I do that. But anyway, getting back to where are we now, the S&P 500 is above, on a weekly basis at least, its 50-day moving average. So we have no downside daylight just yet. But what's interesting is, and again, probably a little bit more fodder for research, but we're getting dangerously close to that 100 period in here. So that has me a little bit concerned. Now, if the market starts going back up, it just starts going straight back up, obviously I'll start putting on more longs, and I'll also keep any longs that are left over. But I'm going to make sure that I'm taking profits along the way as my money management dictates. So I'm not just holding on when this thing finally does tank. Now, if you take a look at the daily, again, patterns are fractal. You'll notice that recently we've had some downside daylight. And look, lo and behold, there's that 100 reading. I mean, I'm seeing this as I'm showing this to you. By the way, that's why I love teaching, because I learn a lot in the process. I didn't even realize we hit that 100 mark on here until 2 seconds ago. But recently we've had a little bit of downside daylight. Not the end of the world, okay? No need to sell the farm or even get it appraised, but this is a little bit of concern because what did I say earlier? You can't have a bear market without downside daylight. So on a daily, there are some warning signs, and I think we need to pay careful attention. And again, patterns are fractal. So you can see the hourly S&P, we've had a little downside daylight as of late, right here. Okay. So in summary, I would strongly urge you to use something simple like Dave Light to help you keep you on the right side of the market. Now, if you want to learn more about my Trading Simplified methods, here's a special offer for you. If you go to davelandry.com/fest, I'll give you the slides from this presentation, and then as I said earlier, you'll get the first 4 videos of my course. And remember earlier I talked about my money management. I'll give you 3 articles, one of which is on money management, one of which is on psychology, and another one is on the methodology in and of itself. And also there's a $100 off coupon code. Now, just for festivals traders, if you do sign up here, you're going to get, again, those first 4 videos, and you're going to get this course for half off. It's normally $600, and you could still use the promo code. And here's a little thing, another little tip too. The promo code is reusable, so you can get all 3 books off my website absolutely free. I would rather you get to know me first and then decide whether or not you want to continue on, rather than make a big investment in me. So get the books off my website, read them, watch these free videos, get a feel for what I do. And if it clicks with you, then we can take it to the next step, next level. So again, for more information, of course, you can go to my website. You can email me if you have any questions on anything you heard tonight or the methodology in general. I would strongly urge you to watch those first 4 videos first, read those 3 reports that will come after those 4 videos, and just generally get up to speed. And that way you'll ask questions. You could ask better questions that I could give you better answers, as opposed to me saying, okay, go back and read those articles and then we'll explore it further. And again, you can access everything from davelandry.com/fest.